So, hi everybody, this is Hustle Hub. I'm Giacomo, and today I'm with a special guest. He is John Gibson. He's a CFA chartered. He's a contributor on Seeking Alpha, and today he is going to talk about one of the latest research he has done. So, John, please introduce yourself. Tell us a bit about what you do, what you specialize on, and then we'll jump into the presentation.
Sure. Thanks so much for having me on, Giacomo. I'm glad to be here. I've watched some of your videos and you do a great job. And I think, I'm just happy to be able to add to what you're doing. So again, yeah, my name's John Gibson. I run a fund in Huntsville, Alabama. And we like to look for these and invest in opportunities and companies that we think can double or triple within 5 years or so. And so that's either a company with tremendous growth opportunities and potential, or a company that's significantly undervalued. But usually it's a combination of the two. And I'm going to share about one of those companies that I believe is not only undervalued, but also has a tremendous growth opportunity. And that company is called Streamline Health Solutions. So I guess let me share my screen here. Yeah, again, the company that I'm going to talk about is Streamline Health Solutions. It trades on the NASDAQ under the symbol STRM. Let's see here. So I'll start with the company history and then move on to the products and the addressable market that the products solve a problem for. Then I'll talk about the management and the strategy that they're employing, at the key financials, and then finally a few risks to this investment thesis. Oh yeah, just to start, disclaimer. So nothing that I talk about should be considered investment advice, and nor is this an offer to purchase interest in the fund. And also just a disclosure, we are long this position in our portfolio. So Streamline is a almost 20 plus year transition story, and they're transitioning from electronic health records software to more of a focus on coding software. It's still in the revenue cycle, but it's focused on the bill codes that hospitals use and submit for insurance reimbursement. They did have a change in management in 2019. David Sides was the CEO. He left for, at the time, a bigger opportunity as COO of Teladoc, although now with Teladoc shares sliding like they are, may not have been the best move. But at the time he was CEO, T. Green was chairman of the board. He moved to be the interim CEO while they were searching for a more permanent CEO. But he liked the opportunity so much that he decided to stay on as the permanent CEO. So, and a lot of these transition stories, I think the market overlooks these types of companies because you don't always see the top line revenue growth, because while the company is transitioning to a new product or new service, they're typically winding down a legacy business. So they're losing revenue from that wind down of the old business while they're gaining revenue. So I think Streamline's in a good spot now. The timing is good now, not only because the whole market's down, but you're starting to see that top line revenue growth because they've already wound down enough of that legacy business. The new business is picking up enough steam to make up for that lost revenue. Also, what helped in last year, third quarter of last year, they acquired a company called Avelead. Avelead has a very similar product that Streamline had, and it essentially doubled sales for Streamline. They're both growing very fast, and so far it's been a very good acquisition for Streamline. So what's the problem that Streamline's trying to solve? And it exists in hospital billing. So hospitals now, the bill codes, there's over 130,000 unique billing codes in the international coding system, ICD-10. And so there's a big potential for hospitals to not use the right code, to not use the optimal code. And so there's a chance that they'll underbill and they lose out on money. So they have revenue leakage from that. But even on the other side, when they overbill, it's still a very frustrating experience for the billing staff, for the patient, and the insurance company they're dealing with. There's lost time, there's potential claim denial, and even government fines. So right now, there are some other solutions out there, but nothing that's really addressing this problem like Streamline is. So right now, most hospitals are having to manually audit the codes that they use. And because it's a manual process, they can really only get to 2 to 4% of these cases. So the solution is software, of course, right? Streamline's core product is called Evaluator. But then when they acquired Avelead, they got a very similar product called RevID. Both products are pre-billing. So before the hospital sends the claim to the insurance company, but Evaluator is more of a code auditor and RevID is more of a code optimization. So it's more of a pre-code software package. Both of these products are EHR agnostic. So the big EHR players are Epic. I think they're number one. Cerner's number two. Allscripts. There's many others, but both of these software packages play very well with these EHR systems. By the way, one reason why Streamline wanted to transition away from this EHR business is because it's one of the most sticky businesses out there. The hospitals that we've talked to, they talk about, hey, we've used Epic or Cerner for 15, 20 years. There's no way we can switch. We've poured millions of dollars into adopting this software package. The switching costs are way too high. So that was one reason why Streamline got out of that, or is getting out of that business, because it was so hard to displace one of these major EHR companies. And with Evaluator and RevID, they're going to hospitals that most of them have no solution for code optimization. And so they're able to get those wins and sales that way. Just an example of some the potential for a hospital revenue leakage. So you have two patients, and this is from Streamline's investor presentation, with virtually the same symptoms, and just using the more optimal code, a hospital, or a less optimal code, a hospital loses out on almost half of what they could potentially make if they just use the right code. And hospitals, so when hospitals adopt Evaluator or RevID, they're immediately enjoying a big ROI on their investment. And this makes it easy for Streamline to sell these products to hospitals, because they can go in to a hospital with these examples, and you can see here some of the ROIs that hospitals have enjoyed using Evaluator, anywhere from 5x to over 20x the spend that they have on the software from Streamline. So Streamline estimates that the total addressable market, and they're targeting hospitals with over 200 beds, so larger hospitals, they think that this is a $900 million revenue opportunity. And that's across almost 580 hospital systems. And something that has slowed them down in terms of making new sales has been COVID. Hospitals have been very hesitant to adopt new tech, just dealing with the pandemic. But even in 2021, Evaluator sales grew over 50%, and they have new bookings already reported in 2022. RevID is the same. They actually have a very good relationship with Cerner, and they're being actively introduced to some of the hospitals by Cerner. So like I said, COVID slowed down a lot of hospital adoption of new tech, and I think this is a big catalyst for them to increase sales going forward. And if you look at the news feed for Streamline, you're going to see new bookings being announced, almost every month. There is a potential to cross-sell these products. I mean, currently there's zero overlap in the hospitals that use RevID Evaluator, but I know management it's kind of downplayed this opportunity, and it doesn't look like there's going to be much of this for at least, a year or so. I think the last that I heard from somebody from management was, yeah, there might be an opportunity like 1-2 years down the road. But really the products work well on their own for the hospitals to get the right code to the insurance companies. So T. Green, the current CEO, he is very experienced in medical software. He and his father started Greenway Medical Tech in 1998. They took that company public in 2012, and then I think it was either later that year or the next year, they actually sold to a private equity company for over 650. I think it was close to $700 million. So very experienced in that space. The strategy is organic growth. They actually have revamped the sales team. They have a new head of sales, a chief growth officer. Her name's Amy Zabero. She's got a lot of experience at a company called InThrive, where she worked with over 900 different hospitals. And right now they're targeting 3 to 5 million in bookings per quarter. And so usually these bookings are 2 to 3 year contracts. I think they're going to be able to hit the higher end of that estimate and maybe even more. So, and again, that's the main strategy, is organic growth. But they are open to some M&A. I mean, obviously they bought Avelead in the third quarter of 2020, but the focus right now is organic growth. I think if they came across the right company that was the right fit, they would definitely be open to it. But the focus here is to grow organically, and they're already able and proven to do that so far. And just looking at some of the key financials, so currently trading at close to $59 million market cap. I know the market's moved. These numbers are as of, I believe, early May 10th. So at $1.23 per share, the market cap is at 59 million, with 10 million in debt, 9.8 million in cash, so virtually zero net debt. And right now they're running at a revenue rate of 24 million annually, and that's as of the end of January 2022. So that puts them right at about 2.5 times annual sales that they're trading at. They had over close to 14 million in total new bookings in 2021. And again, they're targeting anywhere from 12 to 20 million in new bookings for 2022. So I think, you're able to buy a company at 2.5 times sales. They're able to pay for all that growth from the profits of the company. They're not having to dilute or issue new debt for that growth. The debt that they have on the books was related to the acquisition of Avelead, and they did issue some shares for that. But overall, they're able to pay for their growth from profits from the company. So you have a situation where you have a company that could potentially be growing at 30, 40% a year and trading at 2.5 times sales right now, which I think is a tremendous opportunity. So just to look at how Streamline's valuation compares to two other publicly traded companies that have software in the revenue cycle for hospitals. So again, Streamline trading at roughly 2.5 times sales. CareCloud's another company that looks very cheap compared to Streamline, but CareCloud, they have over 61 million in preferred shares that are yielding 9%. So they have a much different capital stack. It's going to cost them a lot to unwind. Plus, they really haven't been able to grow organically. All their growth has come from M&A activity. I think RCM is going to be a better comparison, even though they're a much larger company. But you can see they're trading at over 4 times sales now. And they were growing at about 30% per year until they got to roughly 6 billion. And then the last couple of years, their sales have their growth has slowed to 10 to 12% per year. So even though Streamline's a much smaller company right now, I think their their higher growth rate and their bigger potential, they deserve a multiple closer to this RCM company. And I don't have a slide for the risk thesis. I was just going to point out a couple risks. Could be, of course, increased competition from companies like CareCloud or an RCM. There's several others. Maybe maybe an EHR, like it doesn't look like Cerner's interested, as they're actively introducing Rev ID to their clients, but say like an Epic comes out with their own software package that solves this issue of code optimization and audit. And then also, I think there's a real, because there's so much consolidation in this space, there's a real potential for Streamline to be acquired and for investors to miss out on that longer term growth potential that they have. So say they're acquired at a 30 or 40% premium or something like that. Well, I think investors should be looking for 3 to 5x growth from the current share price now. So there are other risks, of course, market risk. COVID could flare back. Now there's monkeypox going around or not our country, but I guess there are some cases in the US, but around the world. So who knows what happens, where hospitals may have to shut back down again and they close off to adopting new tech. But barring that, I think the market has presented quite an opportunity to invest in a growing, healthy company like Streamline. So just a note on the debt is a 5-year term. It is variable, but they've got very favorable payoff terms. So it's at prime +1 right now. Prime's at 4. With the interest rates going up, if you look at prime, it really hasn't gone up in proportion with the rest of like a 30-year mortgage rate. So it's still at 4%. I think even 2 years ago it was at 5.5. So I want to say if that got really high, Streamline would probably look to restructure that. But right now it's very favorable terms, very serviceable for them. So yeah, I think that about covers what I wanted to go through. Unless you have any questions about it.
Yeah. One question that I have is, do you have data for the sales growth of the main competitors that Streamline has? And is it outperforming its main competitors on the growth path, let's say?
Yeah, I mean, there's really not any product quite like Evaluator Rev ID. When Streamline goes to a hospital, they're not having to displace any competitors right now, or any or compete with it. They're not addressing like a request for proposal where they're head to head with some other competitor. I mean, like if you go to different sites like Care Clouds or RCM, they say they have software that addresses the revenue cycle and helps with bill coding, but I don't know. There's not much out there really. I mean, Streamline talks about this opportunity being like a green field, like almost it's there for the taking. So right now there's not much to compare to in terms of what their product solves and the growth trajectory. And like I said, a lot of them now, the growth is slowing for RCM. For Care Cloud, it's basically not growing organically. They're having to acquire their growth. So it's really hard to find anything that compares to what Streamline's doing.
Okay. So you talked about the debt position. So on the other side, on the flip side of that, you said that maybe it could be an M&A target, but do you see in a current environment something like that happening? Is that likely in the next few years? And what are the kind of companies that could look at Streamline and think, okay, this is a target that is really could be a pivotal point for them to buy? You talked about Cerner. Are there any other companies that you think could take a look into Streamline and maybe buy it?
Yeah, I think there's, I mean, of course, like RCM could be one, and really any of the large EHR, electronic healthcare records companies could be interested. I don't think in this market environment, I mean, I'm sure there's that potential just because everything's so depressed. You would think that companies would take advantage of the depressed pricing and make an offer. Although right now it just doesn't seem like there's too much of that going on right now. It's almost like everybody's just hesitant to see how far depressed everything gets. But at the same time, I think Streamline would definitely, resist such a takeover just because of the opportunity in front of them. I mean, I don't really know. I haven't really heard management talk about that, but certainly the idea now is, hey, let's grow as large as we can organically, and then maybe seek that. But if you look at Greenway Medical, for instance, I mean, they went public, and it wasn't. I don't even know if it was a year later that they were acquired by a private equity company. It was more than double what they IPO'd for. And that was in 2012 and 2013.
Okay. And the last question that I have is, are there any similar healthcare systems like the US that possibly Streamline could target for expansion? Is there something similar where Streamline could expand outside of the US?
Yeah, I think so. I mean, that coding system is like an international standard. And so a lot of countries use that same system, that ICD-10 system. It's gotten a lot more complex over the years. Right now, they're just focusing on the US, but I think, yeah, down the road, there could be some potential to expand internationally. The US healthcare system is, from everything that I know, is somewhat unique. So, I mean, the billing staffs and the administrative staffs at hospitals, I think in the US are larger than anywhere in the world. And so the big need is here in the US to reduce that administrative burden for hospital systems here. So to answer your question, I'm not sure, but I would think there would be, just because there's that same coding system used, internationally.
Yeah, that makes sense. So I'm done with the questions. You explained these concepts very clearly. So thank you, John, for that. If you have anything else you want to add, you're free to do so. If not, I really want to thank you for your contribution and for your research that you have done today.
No, yeah, I think that about wraps it up. And again, I want to thank you for having me on. It was a lot of fun, and I look forward to seeing all the other episodes that you come out with down the road.
Okay. Thank you. So this is it for today. This is Hustle Hub. I'm Giacomo. See you next time.